How's it going, everyone? Natural Selections Investments here. My name is Jared. Really cool video for you guys today. We're talking about my strategy in the stock market that I call dividend sniping. Really quick, I'm sure we all know what dividends are, but certain companies that are profitable, they like to kind of attract investors by saying, as a portion of our profits, we will give out, a salary to each shareholder in the form of what's called a dividend. Okay, you can see in this paragraph, this is the only part we will read. It says typically a company like PG announces what's called an ex-dividend day, right? And this is the day that you need to own the company in order to receive the dividend. Okay, or well, not technically, it's the day after, right? X meaning no dividend. So if you own it on X dividend day, you are not entitled to it. But it does mark, that transition between receiving the dividend and not receiving it. So yeah, this will make more sense. It says to be eligible for the dividend, investors must own the stock before this date. If the X dividend is set for January 23rd, say a Wednesday, then ownership must be established by the close of the market on January 22nd, Tuesday. This timing is crucial. Even a last-minute purchase at 3:59 p.m. Eastern Time secures a dividend. All right, so now that we understand dividends, let's talk about them. Okay, we're going to start with PFE, which is Pfizer. Okay, so the reason being that this most recent week, they had their ex-dividend day. So really quick, you can see here they have a 6% dividend yield, right? And like I said, their ex-dividend day was 125. It's currently the 27th, right? So think on the 24th, you have to own the company or the shares by market close. You can even buy it at 359, but on January 24th, you must own it. Okay, so you look at the strategy name, dividend sniping, and you might assume, okay, so we're going to go buy a bunch of shares and receive the dividend after the fact, and then sell it, move on. Well, it doesn't work like that. If we look at the chart right here, the 5-day chart, it's a $28 stock. The dividend was 6%, which is about I believe it's a 42-cent dividend, right? So you'd get $42 per 100 shares. And you can see right here, high low is 28.30 right before on 124 at 3:55 p.m. Well, market open the next day, 9:30. It's already at 127.81. And just a few minutes later, it's 27.6. Okay, so that strategy doesn't work, right? For a 42-cent dividend, you went from 28.3 to 27.6. You would have lost all the money that you would have potentially made from the dividend and more. Okay, so that doesn't work. Now, to go further, let's move on to the next company because this already happened. We're going to go to Texas Instruments. Very established company. They too have their dividend coming up soon. You can see right here, January 30th, right? So by Monday, close the 29th, you must own this company to receive their dividend of 3%, right? $5 dividend, 3%. Okay, you do the math really quick. It's like $1.25, $1.30. So let's say it was tomorrow, 164 would go 162.5, but more like the Pfizer example, it'll go more than that, right? So maybe it'll go down to 162. You can never know. So how can we take advantage of this very predictable move where we can make money and frankly isn't from the dividend? As I just showed you, it ain't gonna work. The only thing that we can depend upon is the fact that the price will drop the amount of the dividend and sometimes a little bit more, like in Pfizer. But sometimes, let's say the market is doing really good. If you pair it up against SPY, the SPY is way up the day of the X dividend. It could go up a little bit, but more or less, that dividend amount is removed off of the company. Okay, so what can we do about it? Well, it's actually really simple. All we have to do is make a vertical spread. So now we got real advanced. I don't know if you guys understand what vertical spreads are, but we moved on from stocks and now we're involved in options, okay? Now, options are contracts on stock. So they aren't stock, but they're tied to stock, right? And that's what's important, okay? Let's go to Texas Instruments, actually. So what we can do is we can predict that Texas Instruments is going to drop about 1%, maybe a little bit less, maybe a little bit more, due to their dividend on Tuesday morning. Right, so on Monday at close, just about the 5 minutes before close, what we can do is we can enter a vertical spread. And a vertical spread, on the call side, I should say, a call credit spread, it involves us buying an option but selling an option at a premium, meaning at a credit. Okay, so what does this mean? When you sell a call credit spread, let's say it's a 165, 170 call credit spread. Let's go and sell this. If we look at the graph, right? Uh, so currently it's at 164.25. So it's right about here, 164.25. Okay. You make full profit 910 off of a max loss of 4,000. So think 5,000 in collateral in the hopes of making 910 would be, you know, 9.1% times 2 because 5,000, about an 18% return. Okay. And well, actually, you could probably get it for $1 if you look here. So that actually makes the calculations a lot more simple. Let's raise the price here a little bit. Okay, here we go. So now it's 1,000, 4,000, nice and simple. Okay. So we sell this. And now what does that mean? Okay, if we go back to the table, you're selling the 165 call, which is more valuable, okay? And then you're buying the 170. If we split these up, we go back to single. The 165 call is 132. The 170 is 32. Okay? So what does that mean? You can sell this, you make $132. But you need to put up 100 shares in collateral. And that's not good because like we said, the stock is going down from the dividend. So what do? You just simply buy one step up or two steps up. You buy the 170, you spend 32 of your 132, and you come out at a $1 premium or $100 per contract. And in return, instead of having to hold 100 shares, all you need to hold is a difference in cash and not stock, right? So 165, 170, that's $5 times 100, right? Then 10 contracts, 5,000 or 500 in collateral to receive 100. So 100 for 500. Okay. And why is this important? Well, if we buy this for 130, if we buy the vertical, I should say, for 100, Texas Instruments is going to drop 164 to, let's just say 162, exactly $2. Now we can actually calculate how much we're going to make off of delta, right? Delta is the amount of, I guess, the value of the option will move in accordance to the underlying. Okay, so a $1 move in Texas Instruments in either direction will lead to a $28 move, or really 0.28, but times 100, a $28 move in that same direction. And this isn't a perfect science because you have gamma, and if you understand options, you also have theta, but for the sake of argument, it's 28. So we're predicting a $2 drop, okay? And off of one contract, you have a delta of 28 times 2. That's, what would that be? $56 move per 100, or $500 in collateral for the 100. So this $100 price would drop first 28, so it would drop down to, would that be 72? And then again at 54. I don't know, correct me if I'm wrong. I believe 54. And that leads to a huge profit, right? That's, almost a 50% profit when you look at the perspective of the premium. That would be, instead of $1,000 to buy back the 10 contracts, you only need to spend $500. So you'd make about $500 in this scenario where it goes to 162. And you'd only have to buy it back for 500. You got 1,000 in the beginning, net the 500 easy off of 5,000, about a 10% return. Okay, now this is probably super duper confusing. So I'm going to go over a trade I did last week. I'm not going to use a Pfizer example, and there's a reason why. I did this on CAT, well, I guess this was probably 2 weeks ago, at 1:18, so January 18th, 2 minutes before close, and you could probably guess that 1:19 was the ex-dividend day, right? So on 1:18, 2 minutes before close, the stock was trading at 282. I went into 20 contracts, and one contract is one of these spreads, okay? And it cost me, or I guess really I received 53 or $53 in premium times the 20. You get 1,060, okay? And the collateral was only 1,400, okay? And that's because I did a 25 spread, 20 contracts, and then you subtract the premium from the total collateral and you get 1,440. So overnight, we get the $1 dividend, which, by the way, is a very low dividend yield. The higher the dividend yield, the easier this return is. Then on 1:19, 2 minutes after open, so this is my favorite part, our market exposure is actually only 4 minutes. After open, it opened at 281, I should say. Exactly what we predicted, 282 to 281 basically. And I just bought all those contracts back for 48. Now that wasn't very much. 53 to 48, that's a 5-cent move in the underline. But it's so heavily leveraged that I bought back the 20 contracts for 960. I spent 1,060, about $4 in commission after everything is said and done. So instead of $100, I made 96, or about a 9% return, okay? And then here is what is super cool. SPY hit their all-time high right around this time. So the general market was pushing all stocks, including Caterpillar, up. But this is my market exposure right here. Just that quick little 74 basis point drop in the 5-day trend. It went way back up. But it doesn't matter because we can always predict that on ex-dividend day, there is going to be a little drop, which makes two types of options really valuable. Either buying puts or selling calls, right? And me personally, I like selling options. You have, an easier time because most of the time you don't have to sell, so you don't have to deal with liquidity twice. You only have to do it once, right? And so that is the basics of this strategy. Now, I'm not the best teacher, probably didn't go over everything I wanted to. So if you like what you heard, you can do two things. You can watch, or I should say read, my free 20-page document on this strategy. And this is my favorite part. At the bottom is my dividend sniping list, right? My about 100 companies that I use to do this strategy, because you don't want to do them all. And there's reasons that you'll learn about in the PDF for reasons why. Now, there's one other thing you can do. If you don't like reading, me personally, I'm going to be honest, I don't think I'd be the type of listener to actually read this. There's one other thing I do have. It's my Discord, right? So also in the description is my Discord, Natural Selection Investing, okay? And here we have free alerts, but more importantly, I have a $5 a month subscription that gives you access to my very specific dividend alerts, right? So the most recent one I did it, on Pfizer, of course, $14, and it's very, very, I've got a lot of information. It's not confusing. You can read all this. Options premium, $14. Well, you saw in Pfizer stock definitely went down as we predicted, so we made max profit on this. So if you want to join this Discord and have up-to-date live even trades with me, click those links in the description. If you have any questions, just find me at any of my socials and DM me on Instagram, etc. But yeah, I hope that you guys learned something from this video. Thank you for your time. We'll see ya.